Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss pre-holiday trading strategy for gasoline.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss my favorite seasonality strategy. I'm a big fan of seasonality or counter strategies. I mentioned it several times in the past videos. I consider them very solid and very reliable because we are all human and seasonality strategies are usually based on some solid fundamental demand and supply factors, usually based around same days in the year or some predefined periodic events over the week or over the day. We have a lot of them in our database, around 100 of them. What I would like to show you is the pre-holiday effect. Here is the pre-holiday effect in equities. The idea is that in US we have around 8 or 9 public holidays when the market is closed, and the day before the market is closed there is lower liquidity in the market, the lower participation because a lot of the people are already traveling to see their relatives, and over those days there is upside drift in the prices in US stocks. So this is the pre-holiday effect in the equities. So as we are nearing in the Western Hemisphere to the part of the year when there are a lot of holidays, in US it will be the Thanksgiving, then we have a Christmas season, then we have the New Year. Of course, a lot of the people will be traveling. And how are they traveling? They are traveling usually by car, by bus, by plane. And yeah, there are some electric cars, but most of the cars they use the gasoline. Most of the planes they use the gasoline. So what does it mean? Few days before the actual holidays, the price of the gasoline goes up. And what is interesting is that you can profit from this upside drift in the gasoline and upside price drift in US crude oil. We have an article called Pre-Holiday Effect in the Commodities, and this is the article in which we try to check if there is such a drift in the crude oil market. So our hypothesis was that increased demand from crude oil before the US holidays causes a short-term price drift. So that was our hypothesis. So we downloaded the data. We wanted to build this strategy easy, so we do not want to use any crude oil futures or stuff like that. So we downloaded the data for ETFs, for US State Oil Fund, USO, and for United States Gasoline Fund, UGA. So those are the two underlying ETFs that we will be using for the trading, and the backtest period is from 2006 or from 2008 to 2024, of course. Here is the list of the holidays. So these are the holidays. Of course, there are a lot of more holidays all around the world and also in the US, but this is the list of the holidays during which the market is closed. So this is like the most important thing. So when the market is closed, people who are trading the market, they usually do not have a reason to stay in the office. They have a longer weekend. All of those people, they leave the office and they go to see their relatives. So there is little less liquidity on the market, and also there is a demand from all of the public to buy the crude oil and buy the gasoline. So here is our analysis. So we checked what is the performance 5 days after the public holiday. So D1, D2, D3, D4, D5. And 5 days before the holiday. So D-5, D-4, D-3, D-2, and D-1. So as we can see, especially in the days D-4 to D-1, there is significant updrift. And 1 day after the holidays, the significant downdrift. So, we were not checking what is the performance during the downdrift, but those 4 days before the holidays were interesting. So we checked what is the performance on the individual days, and then what is the strategy if we bought US oil on the D5 on the close, so on the 5th day before the holidays on the close. We hold this portfolio for 4 days, so D-4, D-3, D-2, and then we will sell at the end of the day D-1, which is the day before the holiday when the market is closed. So this is when we will sell it. And here is the performance of the pre-holiday effect in US oil. So we can see that, really positive, 5.7%, 11% volatility, Sharpe ratio 0.5, which is very interesting, and the Kalmar ratio 0.29, which is the performance compared to the maximum drawdown. So this is, very nice. But can we improve it? Yes, we can. We will buy not the crude oil, but we will buy directly the gasoline, and it's very easy because we have UGA ETF. And the performance is even better. Here we can see the T-stats are even higher. So this is the T-stat table. And here is the performance of the actual strategy. So when we buy on the 5th day before the holidays, we hold it for 4 days and then we sell it at the day before the holidays at the close. And here we can see that we have a performance 10% in a year, 11% volatility, Sharpe ratio 0.9, and Kalmar ratio 0.5. Excellent numbers. And we are holding this UGA only about 30 to 35 trading days in a year. We are holding UGA ETF only about 1.5 trading month, all of the days together, and we have a performance 10%. So it's very easy, very interesting strategy, and it's driven by actual demand for the gasoline. So I mean, we can be very, very sure that in the future the edge will stay as it is. So I hope that you liked the current strategy. I hope that you liked the current video. In case it is so, please give us the like, drop a comment in the comment section into this video. Subscribe to our channel, follow Quantpedia, follow our blog, subscribe to our newsletter. Visit us if you want to see more strategies like that. So thank you very much, and I hope that I will see you in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.